Lock in for the next few minutes. Something's unfolding in the silver market that demands your attention. Over recent weeks, massive volumes of physical silver haven't just changed hands on a screen. They've been called for delivery, claimed, and pulled from warehouses like someone with a calculated agenda is clearing the table. Here's what makes this significant. This wasn't supposed to be a major delivery cycle. Yet the volumes being demanded suggest the kind of positioning you'd expect from institutions, sovereign entities, or industrial players who cannot afford exposure when the system tightens. Today, we're breaking down what just occurred, why it matters beyond the daily price action, where the paper market's vulnerabilities lie, and why the next phase could accelerate faster than most expect. Before we go further, a quick note. I'm working to distinguish original analysis from channels that repurpose content without adding value. If you find this kind of breakdown useful, subscribing helps support independent research. Also, for more frequent updates and analysis that doesn't always make it to video format, I've set up a community space, links in the description. Now, let's examine what's actually happening, because the headline should already be clear. Physical silver is moving toward delivery at unprecedented scale, repeatedly, month after month, and that changes everything. Most people track silver through price charts and tickers. That's the surface. The real story lives in the gap between paper contracts and actual metal. You see this gap when major players stop rolling positions forward and start demanding settlement. Think of it this way. A futures market appears deep and liquid right up until too many participants request the underlying asset the contract represents. When that happens, the stress point isn't price, it's infrastructure. Here's what triggered attention. One recent delivery month saw roughly 70 million ounces effectively demanded. Then another substantial wave followed, tens of millions more. Combined, we're approaching 100 million ounces called for delivery within a compressed time frame. For context, that's not routine activity. That's not speculative churn, that's strategic positioning. And it reveals one critical preference. Someone's choosing metal without counterparty exposure over paper claims. Who's behind this scale? The question nobody asks publicly. Who accumulates at this magnitude? Federal entities building reserves? Industrial buyers prioritizing supply security over entry price? Investment funds recognizing physical tightness and positioning ahead of the crowd? Likely some combination. Drop your assessment in the comments. I'm curious what patterns you're seeing. Pay attention to this part. A futures contract is a standardized agreement on future delivery. Most participants never want physical settlement. They want exposure, hedging capability, or trading profits. The system builds itself around the assumption that the vast majority will cash settle, not demand delivery. That assumption enables leverage. And leverage creates the appearance of abundant liquidity. But when contracts reach maturity and buyers stand for delivery, meaning they request the actual metal rather than closing the position, the system's flexibility contracts. Markets can create more contracts rapidly. They cannot create refined metal rapidly. This asymmetry is why physical drain generates real pressure. Why stand for delivery through an exchange rather than buying directly? Sometimes for process transparency, sometimes for specific supply chain access, sometimes to stress test the structure to discover where weakness exists, and sometimes because the exchange is where paper meets physical, and if you want to expose fragility, that's the pressure point. Inventories aren't monolithic. There are bars available for delivery and bars simply in storage. There are eligible bars and registered bars. When delivery demand surges, the critical pool is what's actually committed to settlement obligations. That pool can shrink faster than headline inventory numbers suggest. When it does, incentives shift, premiums adjust, lease rates change, spreads widen, and eventually price responds. But price often moves last, not first. That's why chart watching alone is dangerous. The chart lags the warehouse dynamics. Consider this scenario. You're a large manufacturer requiring silver as production input. Your order book is full, your facilities are running, your customer contracts have fixed deadlines. Then procurement starts hearing supply is tightening, not in retail coin markets, but in wholesale channels. Lead times extend, suppliers add conditions. You realize that running short doesn't mean losing a trade. It means losing production capacity, customers, and market position. What do? You don't buy incrementally in hope. You secure stockpile. You overorder. You lock feedstock. You pay premiums if necessary, because the cost of being wrong exceeds the cost of paying up. Governments don't think like retail investors. They think in vulnerabilities, critical inputs, strategic industries, defense readiness. If silver increasingly functions as critical infrastructure, governments behave predictably. They ensure they're not dependent on external supply during crisis conditions. So they stockpile. They prioritize domestic allocation. They coordinate agreements, and they do it quietly. Broadcasting scarcity invites instability. Funds identify trends, breakouts, macro theses. They see currency debasement, fiscal deficits, declining stability. They want assets that aren't someone else's liability. Some don't just want exposure, They want reduced counterparty risk. They want ownership that doesn't require trusting a chain of promises. That's why delivery becomes attractive. When funds, industry, and governments all pull the same direction simultaneously, the system strains. The paper market functions smoothly when physical demand remains modest relative to outstanding claims. But if claims multiply while physical stays flat or shrinks, the ratio becomes problematic. Markets resolve ratio problems through repricing, rationing, or rule changes, sometimes all three. That's why this matters for smaller participants. You're usually told there's plenty, until suddenly there is night. When you observe delivery requests measured in tens of millions of ounces recurring across multiple cycles, you're witnessing behavior change. Behavior change precedes structural change. Disregard the talking points and calming headlines. Behavior reveals truth. There's increasing discussion of buyers bypassing Western markets entirely, going upstream to semi-refined material, working directly with producers, paying premiums to secure flow. When buyers fear future availability, they stop optimizing for price and start optimizing for certainty. Classic signal of emerging scarcity. You've seen this pattern historically in other commodities. When supply chains become battlefields, capital stops acting like capital and starts acting like strategic weapon. If major buyers are accumulating quietly, who sits on the other side? Every contract has a seller. Every ounce demanded creates a liability somewhere. If sellers assumed most contracts would roll forward but instead face delivery demands, they must source metal in a tightening environment. That's where stress concentrates. Reports suggest institutional positioning has been evolving. Some appear to be reducing risk exposure. Some may be moving from aggressively short to neutral or even positioned to benefit from rising prices. If accurate, it means sophisticated capital adjusts before the crowd, because crowds learn through pain while institutions learn through information. Does this guarantee anything? No, but it reinforces the core point. The real story isn't the daily candle. It's physical flow and the incentives of those who cannot afford to be wrong. How do these situations typically unfold? First, physical tightness appears in obscure places. Delivery behavior, premiums, procurement challenges. Second, policy tightness emerges. Export restrictions, strategic classifications, domestic prioritization. Third, price tightness manifests, moves through resistance, gaps, volatile swings. Fourth, narrative tightness arrives. Media discovers the story and treats it as breaking news. We're somewhere between the first and second phases. That's why attention now matters. A common trap, seeing price advance and assuming it's too late. But in repricing cycles, late isn't about the first move. Late is when the public piles in after structural shifts are complete. If the system is transitioning from paper-dominant to physical stress regime, the new equilibrium price can far exceed the old range. You can feel late while actually being early for the larger move. Understanding regime matters. Silver sits at the intersection of monetary and industrial demand. Gold is primarily monetary. Copper is primarily industrial. Silver is both. It's monetary enough to hoard and industrial enough to consume. That makes it explosive in a world electrifying everything. More solar, more electronics, more infrastructure, more defense technology, more sensors, more automation, all lean on silver. When the pipeline tightens, pressure spreads system-wide. If you're still here, drop "still here" in the comments. It helps the algorithm understand engagement quality. If you've had a silver position work out, share that too. Your experience might provide valuable perspective for others. Silver is moving into strategic material status across multiple jurisdictions. When a metal becomes critical infrastructure, it stops being just an investment narrative. It becomes supply chain security. It becomes national security. Governments don't behave like traders. They behave like accumulators. They stockpile, restrict exports, prioritize domestic needs. They do it quietly because broadcasting scarcity invites panic. Add refining capacity to this equation. If a country or bloc controls significant global refining, they can throttle flow without touching mines. They effectively decide what ships, what delays, what stays domestic. If export rules tighten while deliveries surge, you get a squeeze forming from multiple directions. Industrial demand cannot run on claims. Picture this carefully. On one side, a paper market built on claims. On the other, real-world demand that cannot operate on claims. A solar panel factory cannot install paper silver. A defense contractor cannot wire paper silver. An electronics manufacturer cannot solder paper. They need atoms. Once industrial demand starts behaving like a buyer of last resort, price discovery stops being orderly, because they don't get to say, "It's expensive, we'll wait." Their entire production depends on it. The moment delivery becomes widespread behavior, the ability to endlessly roll and recycle claims breaks down. Same reason every financial scheme collapses when withdrawals exceed inflows. As long as participants accept statements without demanding redemption, the system looks stable. When enough demand the underlying asset, the system must prove it has what it sold. That's the vulnerability. A coordinated shift toward delivery is a structural threat. I'm not saying every contract is fraudulent or every exchange is empty. I'm saying something simpler. A paper system stays stable only when redemption demand remains low. Right now, redemption demand isn't low. It's rising, persistent, and coming from well-funded, well-connected, likely well-informed entities. That's why this matters. Because retail isn't leading. Retail always arrives late, gets the scraps, gets the headlines after supply is already allocated. If you're waiting for mainstream alerts saying physical tightness is here, you'll get that notification after the accessible portion is gone. Many assume higher prices automatically bring more supply. True for some commodities, but silver is anomalous. A large portion of global production isn't from primary silver mines. It's byproduct from mining copper, lead, zinc. Silver supply does not scale quickly with silver price because production decisions depend on those other metals' economics. Even if silver price climbs sharply, supply doesn't instantly respond. In a world where demand rises from multiple fronts, industry, investment, government, that's a formula for violent repricing. Gold is hoarded. It sits. It can be recycled easily because it's stored in large forms. Bars, coins, jewelry. Silver gets consumed in tiny quantities across millions of products. Because it's used in small amounts, it often isn't recycled. Ends up dispersed in landfills, effectively gone. So silver isn't just scarce from mining constraints. It's scarce from physics and economics. Once used, it's difficult to recover. That's why sustained deficits matter. Multiple years where demand exceeds supply doesn't reset overnight. You drain inventories, thin buffers, reduce resilience. Then a small shock becomes a major crisis. Who pays the highest prices? If the public arrives last, who gets caught paying peak prices? Almost always the late wave. Early buyers accumulate quietly. Industrial buyers panic buy. Funds chase performance. Retail arrives because they see the chart. By the time retail shows up, the market is already in a different regime. That's why you don't want to wait for perfect confirmation. You want to understand structure while it still looks unremarkable to everyone else. Silver is mined in far smaller proportion to gold than markets often price it. Historically, the gold to silver price ratio has swung wildly. At times, silver has been so undervalued relative to gold that 1 ounce of gold buys an extreme amount of silver. Those extremes don't persist. Markets mean revert and can overshoot. If the ratio compresses, silver doesn't need anything mystical, just needs to become less undervalued relative to gold. If that happens during physical supply tightening, the move can be sharp. Part of why metals get revalued isn't that metals change, it's that the measuring stick degrades. If you measure a melting ice cube against another melting ice cube, you can convince yourself nothing is happening. Comparing currencies against each other often hides truth. A more honest comparison measures currency against hard assets, gold, silver, things that can't be printed. What you usually find, currency purchasing power erodes far faster than official narratives admit. Simple example, housing. People say homes went up, assets boomed. But remeasure in gold, you often see the opposite. A house that doubled in dollars might be cheaper in ounces of gold. The house didn't get more valuable. The dollar got weaker. Inflation can make you feel wealthy while you're actually treading water. When gold and silver rise, sometimes that's not them strengthening, it's currency weakening. And that weakness is built into debt-driven systems that expand over time. Connect this to today's delivery trend. If sophisticated buyers believe currency purchasing power will continue eroding and physical supply is tightening, what do? They front run, they accumulate, they remove counterparty risk, they take possession. They do it before the public understands why. Why isn't this widely recognized? Headlines focus on price. Mainstream coverage prefers simple narratives. It's uncomfortable to discuss structural stress. And the paper market works fine until it doesn't. It's not supposed to look like crisis until it is. What should smaller participants do? First, don't panic. Second, stop letting daily price action distract from structural signals. Third, think in terms of exposure and control. If you own something depending on someone else's promise, you carry counterparty risk. If you own something you can hold, you reduce it. I'm not telling you what to buy. I'm telling you what to monitor. Delivery volumes, inventory movements, export regulations, industrial procurement behavior. Those are the levers that matter when a market transitions from paper mechanics to real-world constraint. If industrial buyers feel insecure, they don't buy incrementally, they buy aggressively. They lock supply contracts, build stockpiles, shift from just-in-time to just-in-case. That shift creates an accelerant effect, pushing prices beyond what charts predict. Simultaneously, funds chasing out performance notice. They see metals outperforming other assets, see breakouts, see momentum, and they pile in because they can't afford to lag. Finally, retail shows up asking, why is silver moving? The answer, it was moving behind the scenes for months while you watched the wrong signals. If you've had success in business, investing, career, anything, share a line in the comments. Not to show off, but to motivate. Seeing real people succeed raises community morale and reminds everyone that progress is possible. Why big buyers? Prefer silence? If a market is tight and you want to accumulate, you don't advertise your shopping list. You buy quietly, spread across channels, use intermediaries, use delivery mechanisms, let prices stay calm as long as possible. Once the crowd catches on, premiums for physical skyrocket. That's why you should treat this period as informationally valuable. It's not the final mania stage, it's the quiet accumulation stage. If you believe physical supply is abundant and paper is perfectly safe, ask yourself, why are buyers choosing delivery over rolling? Why are direct deals for semi-refined material being discussed more frequently? Why do export restrictions and domestic prioritization keep appearing in policy language? Those aren't behaviors of a market swimming in surplus. Those are behaviors of a market preparing for constraints. Question for the comments. If you could only pick one driver for silver as next major move, industrial demand, government stockpiling, or investor response, which would it be and why? Track 3 layers. Layer 1, physical flow, deliveries, withdrawals, inventory changes. Layer 2, policy and supply chain, export rules, strategic classifications, refining bottlenecks. Layer 3, psychology. When the crowd finally understands the first 2 layers, they react emotionally and volatility spikes. Track these layers to avoid getting whipsawed by daily noise. For real-time updates, join the community channel, link in description. By the time video content is edited and uploaded, markets have already moved. Quick notes and voice updates can be shared instantly when something changes. We're in a world where multiple regions want supply security, where electrification increases silver demand, where defense and high-tech demand doesn't slow just because prices rise, and where mining supply is constrained by geology, permitting politics, and the fact that silver is often byproduct. That combination isn't a recipe for stability, it's a recipe for periodic shocks. Delivery behavior indicates very large players are positioning for those shocks right now. Skeptics will say, markets always find a way. Sometimes they do, but sometimes that way is much higher price. Sometimes it's rationing, sometimes it's longer lead times, higher premiums, tighter terms. If you've run a business, you know what happens when supply becomes unreliable. You overorder, build buffers, lock contracts, stop caring about small price differences because the cost of shutting down is worse. That's industrial mindset. Now imagine that colliding with hedge fund mindset. Funds chase returns, industry chases continuity, governments chase security, retail chases narratives. When all 4 converge, something breaks. The only question is when. I'm not trying to create alarm, I'm trying to create preparation. Preparation is calm. Panic is what happens when you ignore signals until the last minute. Here's the key takeaway. What just happened isn't rumor or headline. It's a documented surge in delivery demand, repeatedly across months, at scale suggesting strategic accumulation. Once strategic accumulation becomes a trend, it tends to self-reinforce because every buyer who arrives later pays more. If you found value in this breakdown, 3 quick actions. First, subscribe so you don't miss updates. This story is moving quickly. Second, join the community channel through the link in description for instant voice notes and premium updates. Third, drop a comment with your theory about who's taking delivery, or share your thoughts on what to monitor next. Take care of yourselves, take care of each other.